Hey everyone, me Kevin here. A lot is being made about the housing crash that's coming, and will it potentially evolve into a foreclosure crash that's potentially worse than 2008? In this video, we're going to break this down, the entire housing market, into 16 very important pieces of data, and by the end of this video, as we go through these 16 pieces, you should really have a strong takeaway in terms of what's actually affecting the real estate market, and how bad does Goldman Sachs believe the real estate market actually has to fall? How bad are interest rates going to get, and how long are they going to stay there? We'll learn about which markets might suffer the most. We'll also learn about credit scores in different markets, which is quite remarkable that we can now break down credit scores in different markets, and we'll learn a whole lot more about the housing market. So we're super excited to bring you this Goldman Sachs research. Let's go ahead and jump right into it. Now, keep in mind that we are looking for accredited investors for House Hack to take advantage of whatever dip we get in the housing market. Now, my goal is not to try to sell you this idea that we're definitely going to have a massive housing crash here. It's to be realistic with whatever the data is, because we have to make sure that when we allocate capital from accredited investors who are investing in House Hack, that we do so in such a way that we're able to build an amazing company and build the most value possible for shareholders. So check out House Hack via the link down below if you're an accredited investor, and if you're not yet, wait until January. We should have some neat updates for you. So first thing that we really want to keep an eye on is we want to look at sort of the chart of bankruptcies and what we've seen with personal bankruptcy history over the last, really 30 years here. Well, what you can see is, even relative to the recession era or slightly before the recession era over here, you can see we're substantially lower in terms of the levels of personal bankruptcies. We saw this massive decline over here, and that's really because of the everything bailout of the Federal Reserve. And personal bankruptcies are really important when it comes to the housing market, because if individuals feel like they're so saturated in debt that they have to file for bankruptcy and essentially completely reset their debts, then we're obviously in the kind of market where it's more likely that we're going to see foreclosures, right? Let's get a little bit more insight here. So when we look at financial obligations of individuals, of all of their financial obligations together, debt payments, lease payments, property taxes, rents, relative to their income, individuals in America actually have still a pretty dang low debt to income ratio, which is very, very good. So again, their financial obligations relative to their income, in terms of a ratio here, some of the lowest levels that we've really seen, and we really haven't gone to pre-pandemic levels where we were at a ratio of just over about 15, or certainly pre-2008 levels where we were sitting around 17 to 18 in terms of a level regarding this chart that Goldman Sachs here is using. So we're climbing again, so we're starting to see some of that personal debt increase, but we're nowhere near the levels that we had previously seen. And we look over here at households, so not now talking about homeowners, not just potentially everyone who's also a renter. We're also at these levels here where on a household debt to income ratio, or debt service ratio, we're substantially lower than what we have seen historically, right? So if we put sort of a yellow highlighter over here on the historic region, and we put a little circle around where we sit now, just relative to the recession, where people had potentially 110, 120% debt to income, now all of a sudden we're actually substantially lower than that. We're in that 70% range, right? This is a huge difference. That's a 50 basis point difference. And so what you're really doing is you're establishing a substantially stronger household today than what you had before the Great Recession. The Great Recession was really one marked by massive debt and speculation, people without jobs getting loans, dead people getting loans, terrible credit scores getting loans, right? The average credit score back before the recession, or the Great Recession, was somewhere in the neighborhood of 660 to 680 for home ownership, which is just terrible. And now you've actually seen the average FICO score come down a lot in the last couple of years here, but still way higher than the averages that we've seen of between 660 to 680. We're actually here now somewhere between 720 and 760. The lowest levels of average FICO scores, actually right here, Miami and Detroit highlighted in green here, with an average of 725 for Miami and 721 for Detroit. But otherwise, if you look over here, most of these credit scores are around 740, which is really where you want to be when you're buying a home to get the best interest rate. And most of the large cities that we have, throughout the United States that are charted here are actually showing relatively strong FICO scores. So kind of a neat element here that we can pay attention to for research of, okay, what are potentially weaker areas, or where could we potentially see more stress? Generally, individuals with lower credit scores, not always, but oftentimes individuals with lower credit scores are more likely to default on their obligations. That's why credit scores are created, to sort of be a measure of financial risk, like how likely is somebody to foreclose, how likely is somebody to default on their debts, right? So over here, we have an all-price tier of housing, and we actually do start seeing this decline in all levels of housing prices, and this is something that we've already known, right? You look at the Redfin data center, we already see that housing prices seem to have peaked between February and June, depending on which area you are in the United States, and they've come down somewhere around 6 to 7% so far. That's not by any means a massive crash, and we're still substantially higher than where we have been pre-pandemic. There's no doubt about that. But we're starting to see that quarter growth, or even that month-over-month growth in housing really start to trend towards the downside. And we wouldn't be surprised if that growth in housing prices actually starts turning more negative beyond what it already has on sort of a national average. Then the next thing that we want to look at is over here. We're going to look at the share of young adults living with parents. This is interesting because usually this cohort is going to help us. Young adults are going to create households and form households, right? And we're actually at a little bit of an above trend for household formation. If we take a peek right here at this chart, we can see we're a little bit above trend for household formation. If we're sitting around that 3-year moving average, or we're kind of maybe slightly below it right now here. But if we look at this sort of on a zoomed out basis, we've seen this household formation trend clearly move up here. But we're actually stunting some household formation a little bit in that we're seeing a lot of 18 to 34-year-olds still live with their parents relative to the recessionary era. Take a look at the Great Recession over here. We were somewhere between 27 to 29% living with parents, whereas now we're sitting around 32 to 33%, really delaying some of that household formation. That could actually create, in sort of this next bottoming process for real estate, could create a lot of demand, and housing could potentially rebound faster than we would otherwise expect, as maybe more people actually engage and get into the market. By the way, if you're unfamiliar with investing in real estate or building wealth through real estate, make sure you check out the programs I'll link down below on building your wealth with real estate. There's a 0 to Millionaire course on real estate. It teaches you everything that I know about building wealth in real estate as a property manager, as a broker, as an owner, as a lender, you name it. You can learn everything, and from everybody involved in our company as well. So you've got some really great insights. Well, maybe not everybody, but for many other individuals as well. So take a look at the programs on building your wealth, and you get lots of insights on building your wealth with real estate. Okay, so then we've got bank lending standards. We're starting to see those tighten a little bit, which the last time we really started seeing bank lending standards tighten was over here in the Great Recession. Not uncommon to see lending standards kind of compress and tighten as banks start getting a little bit nervous about, we got to be careful here. Things are starting to fall. But foreclosure activity right now, at least, still extremely low levels relative to where we ever have been at before, and we're really only now seeing a slight inflection up because the forbearance programs are running out, but otherwise we're not really in a situation where we're really expecting a massive foreclosure crisis. Instead, we are seeing a sentiment decline in real estate. And so that's probably the biggest thing we have now is some of the lowest levels of real estate sentiment that we've seen since about March of 2020, which was when there was some real panic in homebuyer sentiment. But that was very, very brief. We saw that sort of Larry Kudlow style V-shaped recovery here. And also almost back to the levels of 2011 in homebuyer sentiment, which is really remarkable. That could be something that really weighs on the housing market over the next few years. But I think a lot's going to come down to interest rates, not so much inventory, because inventory is still historically very, very low. So you're going to really need a combination here of inventory maybe staying stable, but high interest rates and lower buyer sentiment leading to less demand for real estate, right? So over here you could see new single-family homes under construction and single-family homes for sale. If we combined both of those, So we take all of the homes under construction and assume that they're for sale right now, combine those with the existing housing inventory, we're still way lower than where we were over here in 2019 or really any time before that. So very, very low levels of inventory. Even if we built everything, if everything tomorrow was done being built, we'd still have depressed inventory, right? Now, what's interesting is Goldman Sachs is actually expecting mortgage rates to come down a little bit towards the end of the year, because right now they're at about 6.6%. They think they'll go to about 6.4% by the end of the year, but no big drop by the end of 2023. Now, this is a big red flag in my opinion, because if we sit over 6% on mortgage rates for a whole nother year and a third, basically, another 15 months, I think we'll actually continue to see year-over-year declines in real estate starting in about March, where we look back to peak and we go, oh no, real estate's down 8 to 12% in certain markets. That could lead, combined with bad housing or homebuyer sentiment and low purchasing power because rates are so high, then we could actually see housing move from maybe 8 to 12% declines to, by the end of 2023, somewhere around 18 to maybe 25% declines because of fear. Not necessarily because we saw a big surge in inventory or because we saw a massive amount of foreclosures, which there's way too much equity. People have just way too much equity for us to really see that. But just a combination of affordability and rates really pushing things and resetting things back down 18 to 22% or so. Not going to give us 2011 prices, but potentially give us slightly before pandemic pricing, basically pre-pandemic pricing. So something really to pay attention to here in terms of a potential. This is Goldman's forecast again, that they're expecting those mortgage rates to stay above 6%. And really what I thought was quite remarkable here was this argument here, that you're starting to see this projection. My projection is obviously slightly different here, but you're seeing this projection here from Goldman that they actually believe we are going to see a 4.1% decline in real estate in 2023 and still a 7.5% bump in real estate prices for 2022. Now, I think they're going to be wrong on these measures here. I think we've already seen a 6.5% decline, so we're going to see somewhere between an 8 to 12% year-over-year decline. But what's remarkable is, and that's by March of 2023, but what's remarkable is they're changing their estimates to the dark side, right? So their estimates are worsening. And I've often seen in real estate these Wall Street estimates really really lag what actually happens in the market. But we've already seen a 6.5% off-peak decline, so I wouldn't be surprised to see that escalate to 8 to 12% for a minus year-over-year, and then we get that fear combined with affordability and high mortgage rates, which they expect to last all the way through the end of 2023. I kind of agree with. We don't expect to see a Fed U-turn or pivot anytime soon. And so they believe that's going to lead to an overall decline in real estate prices, certainly next year, but also potentially some markets, what they say here, certain overpriced markets like Boise and San Diego, potentially seeing over 20% price reductions. Now, that's really interesting, because what this is telling you is that finding real estate and the real pain deals is going to take effort. It's going to take studying. It's going to take becoming an expert in many different local markets. And it's going to take a lot of work. Again, the buildup of home equity here should be an insulation to foreclosures, as we see Goldman saying here. I completely agree with this segment over here. But again, there will be opportunities in real estate, and I think it's in everybody's best interest to prepare for those opportunities. Lower your outstanding debt. Get ready, but don't expect a 2008 style recession. And so anybody really perpetuating that with fearful music or clickbait or whatever, in my opinion, is really creating too much fear, where we should actually just be excited about the opportunity to maybe be getting real estate at like a 10 to 20% discount and be happy with that. Do we really expect we're going to see a 40 to 55% decline in real estate? I certainly don't, but I'm interested in hearing what you think. Let me know in the comments down below. Again, if you're an accredited investor, go to househack.com. Just make sure you bring your letter. Go to investready.com to get a letter. In fact, you can even go to househack.investready.com, and that's sort of our splash page with InvestReady, the partnership that we have actually just created with them, which is pretty cool. So check that out. Get your accredited letter, upload it to HouseHack, and join us as we find the best deals possible over the next few years and build an amazing real estate company. All right, folks, thanks so much for watching, and we'll see you in the next one. Bye.